Alright, this is going to be a quick video on the options spread I use, or the strategy I use rather, to sell put spreads. Credit where credit's due, the combination of delta that I'm now using, I get from the idea from Carl Allen. He's an options trader. He runs a website called Data Driven Options, and in here he'll go into detail about why the specific 2013 delta combo. And I'll discuss that as we move along. But you can view more at his website. It's a lot of information, a lot of stuff you can learn about options selling in general here. But that's specifically where you can learn more about the reasoning behind the 2013 delta split. His put spread strategy is a little different than mine in terms of risk and expiration and all that, but I use the same 2013 delta combination he uses. All right, into the spread idea. So every Monday I open it up, and I'm assuming you already know how to sell credit spreads and you're already familiar with options trading and put spreads and how credit works. So I'm not going to get into any of that, but every Monday I open it up to the 18 DTE. This is currently Thursday, 22 DTE, but on Monday that will say 18. So I come open the 18 and I'll go down to the 20 delta. Which has roughly a 20% chance of going in the money. So you have an 80% chance of being right, which is high odds. So I'll go in there and I'll go to the 20 delta and I'll sell the 20 delta and I'll buy the 13. What I'm really looking for is $10 or less between the short and the long. So the spread value, the gap between the short and the long, I want it to be at least $10 or less. I want the profit to be 10% or more than the max loss. Now, for my particular strategy, I'm going to set a stop loss of 2x. So if I sell this for 78 cents, we'll just say 80 cents for ease of math. If I sell it for 80 cents, my stop loss is going to be $2.40, which would be risking 2 to make 1. So I'm going to risk $2.40 to make 80 cents. Now my risk is slightly skewed there because I'm not going to make the full 80 cents. I'm going to set my profit target to 3 cents. You could let this expire worthless. I'm not a fan of letting it expire all the way worthless because even on the day of expiration and you're still out of the money, the market can close, the market could then crash, and your out of the money becomes in the money and you can't do anything about it. And then you get exercised. Exercise is not a big deal. It would just mean max loss, as well as maybe additional fees for exercising, and depending on how your broker structures that, could come with some additional fees. But yeah, I typically just try to exit it at 3 cents profit target, which is about a 95% profit instead of 100% of the credit. So how this spread would work is I would open it for 80 cents. I'd set my stop loss for $2.40, and I would set my profit target for 3 cents. Now, I'll usually try to use about $5,000 of buying power. So I'd bump this quantity up. 7 contracts puts me at $5,000. That's your typical trade. And you can see the max profit I'm going to make from this would be $560 versus a $5,000 or $5,040 max loss. Now I'm only going to risk 2x that, so I'm risking $1,120 to make $560. The profit or the profitable margin on this is rather high. So you're going into it right away with an 80% chance of being right. So 20% of the time you can expect to be wrong. Being a 2x, 2 to 1 risk reward, you're going to come out on top in the long run, and I'll show you that with a back test. But that's the strategy: is a 2013 delta at an 18 DTE every Monday with a 2x stop loss and a 3 cents profit target. I typically will try to do, again, $5,000 in capital, getting around a $500 to $600 max profit. Now, if we're market crash recently and we're coming out of a low, like maybe RSI is oversold and you got some oscillators trending up and a few green bars coming out of a recent pullback, that might be a good time to up that risk. Maybe I might go to 7,500 or 10,000 on the max loss, which would get my profit up higher. But usually I float around that $5,000 mark. And you can do this every week to as when the strategy starts going and it starts closing out and you get your money coming in, you're opening up a new one every week. So that's potentially 4 or 5 of these every week or every month, which would be around, $2,000 to $2,500 a month that you'd be making off of this, assuming that you don't get stopped out. Now that's pretty much a strategy. If you have any questions, feel free to ask. But how this looks in a back test would be right here. So what we would do is we would short a put. We would sell the 20 delta, buy the 13. We're going to look at the last 5 years. This would be a 18 DTE. We're going to sell it every Monday, and we are going to take profit at 95%, which is be about 3 cents profit target. And we're going to put our stop loss at 2x and run that back test. So that's going to look at that trade over the last 5 years. I've already done this back test, so it should already be cached and saved. There you go. So buying and holding SPY with the same amount of capital would have netted you $3,400. With this strategy, $6,500. It has less max drawdown, so 30% versus 34 than buy and hold, and it has a higher, almost double the profit margin. So with buy and hold, 84% return over that 5-year period. With this strategy, 159% return. So it's a profitable strategy. It just requires a little bit of capital. You have the potential of max loss, but again, you have an 80% chance of being right every trade. Over time, that math is going to play out, and you're going to have times where you lose. Hopefully, the stop loss. But it can happen to where a big significant market crash or pullback happens, 5%, 2%, 5%, whatever it might be, after hours. And you wake up and your stop loss never stood a chance because you wake up, market's at, say, currently 600, and we sell the 585, and tomorrow we wake up and the market's at 580. That can happen. It doesn't happen very often, but it can happen. And at that point, you would hit your max loss. But this strategy overall is good. It's decent. It creates a great return, as you saw with the back test. And if you have any questions, feel free to let me know, or test it on your own. Do whatever back test you want. But again, if you have any questions, just let me know. And that's about it. Take care.